Welcome to the deep dive. We strip away the noise, delivering just the essential, actionable insights you need. And it's all pulled straight from a stack of expertly sourced material. Today, we are wrestling with, well, it's the dream that fuels millions, isn't it? Financial freedom through real estate investing.
Yeah.
REI.
It's the ultimate financial aspiration for so many. The passive income, owning a tangible asset, feeling like you're in control of your own destiny. But for you, the aspiring investor, that path, it often starts tangled up in uncertainty. Do I really have the specialized knowledge? Is my capital enough? And maybe most importantly, do I have the right internal framework, the mindset to handle the ups and downs?
That is precisely our mission today. This deep dive, think of it as a foundational litmus test. We are deliberately moving past all the motivational hype, the get-rich-quick stuff, to give you a realistic, comprehensive overview of the commitments, the time, the systems, the capital, what success really requires.
Exactly. And our sources today are, well, they're pretty dense, covering high-level investment strategy, the details of creative financing, market analysis, and really the nitty-gritty of operational excellence.
Right. We want you to walk away from this knowing if this path truly aligns with your long-term goals. For real.
So we've organized this sort of self-assessment into 4 key pillars. First, mindset and commitment. Then, financial readiness. After that, investment strategies, active versus passive. And finally, building the operational system.
Okay, let's dive right into that first pillar then. Mindset and commitment. And the very first truth bomb that the sources drop is, well, it's critical for managing expectations. Real estate investing is fundamentally a get-rich-slow game.
Absolutely. That's spot on. If you're looking for those immediate, huge spikes in wealth, you're probably looking at speculative ventures, not sustainable real estate. Our sources define REI as a long-haul compounding process. Success, it's measured in building durable equity and reliable cash flow over years, not weeks or months. Patience and consistency, those are key.
And this slow, steady reality, that's what separates the serious investors from, well, the dilettantes, the ones who fall into what one source cleverly calls the toilets trap.
The toilets trap, I love that phrase, because it perfectly captures that short-sighted cynicism you hear. You're talking about a pathway to freedom, right? Freedom from the 9-to-5 grind, the rat race. And the immediate, almost default criticism is always, oh, I don't want to fix toilets.
Yeah, exactly. They fixate on the noise, the minor stuff, instead of the huge goal, durable financial freedom.
It's a classic case of missing the forest for the trees. And the response to that criticism, internally, it shouldn't be defensiveness. It should be analysis. You ask yourself, okay, what's the actual cost of fixing a toilet? And how does that minor expense, that inconvenience, compare to, say, working for someone else for the next 30 years?
Right. And once you scale up, the goal isn't even to fix the toilet yourself anyway. It's to pay a property manager maybe $100 to handle it. You're aiming for freedom. A leaky faucet, that's just an acceptable operational cost. It's not a reason to ditch the whole plan.
Mm-hmm. And if that long-term vision of freedom is the driving force, the passion, then your success really comes from making sure your daily actions support it. And our sources are super clear on this. You need to focus on your systems, not just your goals. It's like that saying, you don't rise to the level of your goals, you fall to the level of your systems.
Habits are the compound interest of self-improvement. They really form the foundation of successful investment behavior.
But before you can even change your habits, you need awareness. Most of us just operate on autopilot, right? So this is where the concept of the habits scorecard comes in. It sounds simple, but it's pretty profound. It forces you to actually write down every action you take in a day. Then label it, good habit, bad habit, or neutral.
That process, it makes the unconscious stuff conscious. You can't change what you don't acknowledge.
Exactly. And once you have that awareness, the next step in building a system is making the start completely effortless. This is that idea of the gateway habit.
The gateway habit, a 2-minute rule. So, the action that follows the first 2 minutes, that can be challenging. But starting, that has to be frictionless. So if your goal is, say, spend an hour every morning researching potential deals, the gateway habit isn't the research itself. It's just open my notes and the MLS website. That's it.
Precisely. Or maybe you need to do detailed due diligence on a property. Your first 2 minutes are just to review the inspection report cover page.
Mm-hmm.
By lowering that initial friction, you beat inertia. Once you've actually started, the momentum often carries you through the harder parts.
Okay, but systems alone, they can struggle sometimes, right? Especially when you hit that valley of despair, that tough period where you've been grinding. The systems are working, but the results, the deals, the cash flow, they haven't shown up yet. What pushes you through that?
That's where the clarity of your vision comes in. And it has to balance both your personal and professional desires. That clear, compelling why, that's the passion, the energy source. And that vision, it needs to be paired with urgency. The sources really push the 12-week year concept, basically shrinking your planning horizon.
And why is that shorter horizon so powerful for an investor?
Well, think about it. We tend to procrastinate less and focus more when a deadline feels real, like it's right around the corner. Instead of having this vague annual goal like I'll close 2 properties this year, which gives you 12 months to put it off, the 12-week year forces detailed actionable goals like analyze 50 deals, submit 5 offers, and secure financing for 1 property, all in the next 90 days.
Wow, okay. That shorter scope creates an immediate bias for action. Makes sense.
And as soon as that action starts paying off and you begin to scale, you inevitably hit limits. Your own time, your knowledge, your capital. This is where leverage and accountability shift from being like nice ideas to absolutely non-negotiable requirements.
Leverage, yeah. Specifically through partnership, that seems crucial. Investors who try to do it all alone, especially in the active space like BRRRR, they often hit a wall. Maybe 3 or 4 properties in. You need to leverage partners' money or their time or their expertise to get significantly larger returns and scale beyond what one person can realistically manage.
Absolutely. Our sources cite examples of investors realizing they just couldn't swing a single multi-million-dollar property without partners.
Huh.
And bringing them in, it led to exponentially faster results. And this requires a more sophisticated view of accountability. It has to be seen as ownership, not like punishment or consequences.
Ownership, I like that. The investor owns the outcome. Waiting for external stuff, a better economy, lower interest rates, the perfect partner, that's just unproductive.
Totally unproductive. If you want to operate like the CEO of your investment business, you must dedicate time to working on the business, not just get caught up working in it.
Which brings us to performance time. Heard about this. It's a time blocking system. Basically ensures you're spending your most valuable asset, your time, intentionally. It means blocking out specific, non-negotiable hours each week for analysis, team meetings, strategic planning, and treating those blocks just as seriously as a client meeting or, your day job requirement.
Right. It stops that reactive, putting out fires mentality and forces proactive management. Super important. Okay, so we've covered the mindset and systems groundwork. Now, let's pivot to that second major hurdle, capital, money. And the huge takeaway here is you absolutely do not need to be independently wealthy to start investing in real estate. In fact, even the really wealthy investors, they use other people's money,
Yeah.
OPM.
And we should probably clarify why they do that, right? It's not just because they don't have cash.
No, not at all. It's because leveraging debt magnifies returns. Let's do some quick math. Say you put 20% down on a $100,000 property. That's $20,000 of your own money invested. Now, let's say the property appreciates by just 5% in a year. That's $5,000. Your return on your actual invested capital, the $20K, it isn't 5%, it's 25%. 5,000 divided by 20,000.
Wow, that compounding magnified return. That's why borrowing is so central to real estate strategy.
Definitely. But, and this big but, the prerequisite for leveraging, especially when you're really maximizing OPM, is strong financial discipline and maintaining significant cash reserves. Leverage increases risk, period. You absolutely must have reserves tucked away so that unexpected vacancies or, a major repair don't completely swamp you with debt. Never confuse nothing down investing with skipping financial diligence and proper risk calculation.
Okay, good point. So for those just starting out, the sources point towards federally insured FHA loans. They seem like a reliable entry point.
Yeah, FHA loans are popular. They're conventional, but the down payment requirements are generally less strict, often as low as 3.5% down. That makes the entry barrier much lower than the traditional 20% most people think of.
Right. And once you move past that traditional bank financing, the field really opens up. This is where the creative financing techniques come in, getting control of assets with very little cash up front.
Yes, and this requires a whole shift in thinking, away from just the standard mortgage model.
Okay, let's start with seller financing. Here, the seller basically acts as the bank, right? What's the big advantage?
Flexibility and speed. A seller can often offer terms, interest rates, down payment amounts that a commercial bank just won't touch, maybe 0% interest for the first year, or a delayed balloon payment. It also completely cuts out the lengthy bank underwriting process, makes the deal way faster, and cuts down on closing costs.
Interesting. Then we have techniques using existing debt. Assumable mortgages. Those sound like gold if you can find them, especially older FHA or VA loans.
Yet by law, many of those older government-backed loans are assumable, which means you, the buyer, can just take over the existing loan terms. You could potentially lock in an incredibly low, below-market interest rate from years ago.
But the sources also mention a riskier move, assuming a non-assumable mortgage. That sounds tricky.
It is risky. It's a calculated gamble.
Yeah.
Because you risk triggering the due on sale clause. That clause gets activated if the property changes ownership without the lender's official consent. If they trigger it, the lender can demand immediate repayment of the entire remaining loan balance. Right now, if you don't have the cash ready to go, you could lose the property.
Oof. That's a huge risk, but I guess it's sometimes mitigated if the property is cash flowing really well or if the investor has a backup plan, like a hard money lender lined up.
Exactly. It's definitely a high-risk, high-reward strategy. Not for the faint of heart.
Okay, slightly less risky, maybe, but
Yeah.
still complex. Buying subject to existing loans, how does that work?
So with subject to, the investor buys the property subject to the mortgage that's already on it. But crucially, the mortgage stays in the seller's name. The investor just takes over making the payments. This often comes up when a seller is maybe facing foreclosure or just desperately needs to sell quickly. If the investor makes the payments on time, it can actually help improve the seller's credit score.
Ah, okay. So that's the key difference between subject to and assumable. With subject to, the liability, the name on the loan, stays with the seller. With an assumable mortgage, the liability transfers to the buyer.
Precisely. And it really highlights why solid due diligence and having a good real estate attorney on your team is absolutely paramount when you're using these low cash strategies.
Got it. And these creative techniques, they can get even more complex, right? Like hybrid models.
Yeah, things like wraparounds. That's where the seller provides financing for the gap between the buyer's down payment and the purchase price, kind of wrapping around the existing mortgage. We also see lease options. This gives the tenant the option, but not the obligation, to buy the property at a set price later on.
And the lease option sandwich. That sounds particularly interesting for beginners.
It can be.
Yeah.
Basically, you lease option a property from a potentially distressed seller. Then you immediately turn around and lease option that same property to a qualified tenant buyer, but at a higher price and maybe with an upfront option fee. You end up collecting fees and cash flow from the difference, all while having very minimal capital tied up in the deal itself.
Clever. Okay, moving beyond just getting the financing, we have to talk about maybe the single greatest wealth-building aspect of real estate, the tax advantages, specifically depreciation.
Yes, depreciation. It's like the magic trick the government lets investors use. Depreciation allows you to deduct the purchase price of the building itself, not the land, because land doesn't really wear out over its official useful life. Usually that's 27.5 years for residential properties.
Yeah.
But here's the kicker. This is a paper deduction. You get to take it even in years when the property's market value is actually going up significantly.
So it creates these paper losses that can offset your taxable income from the rents, and potentially even offset income from your regular W-2 job.
Exactly, which is incredibly powerful. And for investors looking to really maximize that deduction, especially in the early years of ownership, we get into accelerated depreciation through something called a cost segregation study.
Okay, cost segregation. Sounds technical.
It is. It's a detailed engineering and accounting study. Specialists come in and basically dissect the property into all its various components.
Yeah.
The whole point is to separate out components that have shorter depreciable lives than the standard 27.5 years assigned to the main structure. We're talking about things like carpeting, certain types of wiring, plumbing fixtures, maybe even sidewalks and landscaping.
And these items, they get classified differently, like 5, 7, or 15-year property.
Correct. Which means the investor gets to write them off much, much faster. The impact can be huge. These studies can sometimes generate depreciation deductions equal to maybe 20% to 40% of the entire purchase price, all in the very first year.
Wow. So on a, say, $2 million apartment building, that could mean like $500,000 in immediate paper losses, potentially wiping out your taxable income.
Potentially, yes.
Yeah.
Especially if you qualify as a real estate professional in the eyes of the IRS.
Ah, okay. And that brings up a really critical point. Qualifying for the full benefit of those big paper losses, especially using them against your non-real estate income, that often requires meeting the material participation requirements, doesn't it?
It does. And the IRS wants meticulous proof.
Yeah.
Generally, the rule is the investor or their spouse, or both combined, must spend 500 hours or more per year actively involved in the rental activities. And crucially, They have to spend more time on those real estate activities than on any other single job or business they have. This isn't a casual thing. It requires dedicated time and effort.
And this loops right back to that system focus from the first section, right? If you're claiming these significant tax benefits, you absolutely need ironclad documentation.
No question. Our sources really stress using time logs. Whether that's a dedicated app designed for real estate pros, a detailed Excel sheet, or even just handwritten logs, you need to document specific tasks and the exact time spent on them. If the IRS ever audits you, that paperwork is your only defense. Which, by the way, underlines the need for a top-notch CPA on your team, someone who really understands these complex real estate deductions and isn't afraid to aggressively but legally claim everything you're entitled to.
Okay, so we've got the mindset down, we understand the financial tools. The next big question is, what kind of investor do you actually want to be? Are you going to be active, really hands-on, or more hands-off?
That's a fundamental choice. Let's start with the highly active side. The strategy that really dominates here is the BRRR strategy. That's buy, rehab, rent, refinance, repeat. People call it the gold standard for scaling quickly because, well, it's designed to create equity faster than almost any other method out there.
Okay, break that down, the buy phase. That's finding a property below market value, often needing work.
Exactly. Something distressed or undervalued. Then the rehab phase, that's where you force appreciation. You add substantial value through smart renovations. This value creation is absolutely key because the next step, the refinance, is based on the property's new, higher appraised value after the rehab, not the original price you paid.
Ah, I see. And the genius of the final repeat step is that if the appraisal comes in high enough, the investor might be able to pull out all or almost all of their initial cash investment.
That's the goal. You effectively end up owning this cash-flowing rental property with maybe $0 of your own money left in the deal. Then you take that recovered capital and repeat the process on the next deal.
That's how active investors go from a couple of properties to, well, dozens. We've seen that happen.
For sure. Now, when you're doing the rehab, you've got to be smart about maximizing your bang for your buck. Our sources emphasize you don't need, like, expensive marble countertops everywhere. But you do need modern, clean finishes in the places tenants really notice, like putting in modern tile surrounds in the bathroom showers. That creates an immediate, really positive impression for not a huge cost.
Makes sense. But these active strategies, BRRRR, traditional flipping, they definitely come with risks, right? Especially around hitting profit targets.
Oh, absolutely. Investors might aim for, say, 10% to 20% profit margin on a flip, or the equity created in BRRR. But that's a target, not a guarantee. Yeah. Unexpected delays, maybe material costs suddenly skyrocket, or you run into permitting issues with the city. Those things can chew through your profit margin fast. Sometimes you might even end up losing money. The active investor needs deep risk buffers. Cash reserves are critical.
And success on the active side, it seems like it almost always requires finding a niche. You can't just compete for the same pretty turnkey property everyone else wants.
You really can't. You'll just end up overpaying and probably won't cash flow well. Niching down lets you acquire properties faster, often with less competition. You focus on a specific area or a specific strategy that others overlook.
And the niche examples get really creative. It's not just specializing in foreclosures or probate deals. We see highly focused stuff like house hacking, living in one unit of a multifamily and renting out the others to cover your mortgage.
Yeah, house hacking is a great entry point. And you can get even more granular than that, like renting out individual rooms within a single family home. We saw that example, the sources right. An investor converted a downstairs living area and a 2-car garage into 3 separate rentable rooms. Pulled in over $1,400 a month in cash flow from that one house.
Wow. And that success wasn't just luck. It was because they identified a specific need in that community, huge demand for affordable individual room rentals. They saw real estate as a service, solving a local housing problem.
Exactly. That's the ultimate demonstration of active, focused niche investing. Okay, now let's flip the script entirely. Let's shift to the opposite approach. Passive investing. The most common and probably most accessible way to do this is through REITs, real estate investment trusts.
Right. REITs, you can buy and sell them easily, like stocks. And they own big commercial properties, right? Office buildings, hospitals, data centers, stuff like that.
Correct. They offer instant diversification across different property types and geographic locations. And they give small investors access to asset classes they could never dream of affording directly.
And there's a tax advantage, too, that often gets overlooked. Something about qualified business income.
Yes, QBI. REITs are legally required to distribute most of their taxable income back to shareholders as dividends. And often, that income qualifies as qualified business income, The QBI deduction is pretty powerful. It lets investors take a 20% tax deduction on that REIT income. That can significantly lower your overall tax rate on the earnings. Makes them quite attractive, tax-wise, even for high earners.
Good to know. Now, when you're picking REITs, it's not just about chasing the highest dividend yield, is it?
Definitely not. You should prioritize REITs that offer stable dividends, sure, but also have clear prospects for long-term growth. Think about total return. For example, a REIT yielding 4% but showing solid 5% annual growth in its asset value and revenue. That's almost always better than a REIT yielding 7% but showing zero growth, just stagnation. Focus on the total picture.
Okay. And what about risks with REITs? They use leverage too, right?
Oh yeah. The REIT itself is often borrowing money, using debt, to buy those big properties. So as an investor, you need to look at the REIT's balance sheet. How much debt are they carrying? And critically, is that debt fixed rate or variable rate? In a rising interest rate environment like we've seen, REITs holding a lot of variable rate debt, they face immediate risk. Their borrowing costs go up, and that eats directly into the dividends they can pay out to you.
Something to watch out for. Okay, finally, for investors who truly are non-DIY types, especially if they're investing inside retirement accounts like IRAs or 401ks, where maybe the tax gains and losses don't matter as much day to day.
For them, syndication or funds can be excellent options. Syndication means you pool your capital with other investors. A professional sponsor, the managing partner, handles everything, finding the deal, managing it, financing large commercial properties. Your role is purely providing capital. It's ideal if you have the funds, but absolutely zero interest in the operational headaches. But the key here is doing serious due diligence on the sponsor's track record and reputation. That's paramount.
Okay, so we've established whether you go active or passive, real estate is definitely not a solo sport. You're really only as strong as the system and, importantly, the team you build around you. For active investors, this team is essential leverage.
Absolutely. Our sources really emphasize building what they call the inner circle, or sometimes the millionaire mastermind. These aren't just your paid service providers, like your lawyer or accountant. These are trusted advisors. Ideally, people who have more knowledge, more experience, more success than you do currently. And they need to be willing to mentor you, give you that critical feedback.
That feedback can prevent those catastrophic beginner mistakes, right?
Totally. And beyond mentors, your core professional team needs to be filled with specialists. You need a CPA who gets real estate, understands cost segregation, knows the material participation rules, and is comfortable using all the legitimate deductions, not just someone who does basic tax returns.
Okay. And an attorney who specializes in real estate closings and contracts, especially important if you're doing those creative financing deals like subject to or lease options.
Exactly. And don't forget an insurance agent who specializes in investment properties. They understand liability coverage, landlord policies. It's very different from a standard homeowner's policy.
Right. But for active investors, maybe the single most crucial team member, especially for accurate due diligence before you buy, is the property manager.
Yes. Use them before you even make an offer. They are your eyes and ears on the ground in that specific local market. They deal with renters and maintenance issues every single day. They know what specific amenities tenants are actually demanding in that neighborhood right now. And, crucially, they know the real, achievable rental rates, not just the optimistic numbers the seller might put in their marketing package.
So how do you leverage them? Interview prospective property managers.
Yeah, ask them pointed questions like, if I bought this property, what 3 specific improvements would let me immediately increase the rent by, say, $50 a month? Their answers will help you validate your rehab budget and your profit projections before you commit.
Smart. Okay, team's ready. Now, how do you actually find the deals? We know the ones listed publicly on the MLS are usually super competitive. The best deals are often hidden.
You generally have to generate your own leads. That means actively driving or walking neighborhoods, sometimes called driving for dollars. You're looking for physical signs of deferred maintenance. Overgrown yards, boarded up windows, maybe a roof that looks really old, things that suggest the owner might be distressed or just tired of the property.
And you also need to target properties potentially linked to personal distress. That sounds a bit predatory.
It can feel that way, but it's about understanding motivation. This involves looking at public records for things like divorce filings, probate cases, death in the family, maybe even pre-foreclosure notices. The point isn't to prey on vulnerable people. The strategy is built on identifying situations where the owner's primary need might be speed and certainty of a sale, rather than squeezing out every last dollar. By offering a fast, guaranteed, maybe even cash closing, you solve their immediate pressing problem. That solution is often more valuable to them than holding out for a slightly higher price that might take months to materialize.
Okay, that makes sense. It's solving their problem. And when should investors be the most excited about buying? Is it when the market is hot?
Actually, the opposite. When the general public is scared, running for the hills, that's when savvy investors get excited. Down markets are precisely where most long-term investors build the bulk of their wealth.
Really? Why is that?
Because in down markets, property prices tend to drop faster than rental rates do. This creates more opportunities to find properties that actually cash flow positively from day one. It allows patient investors, the ones with cash or access to financing, to deploy capital at really favorable purchase prices, setting themselves up for potentially massive appreciation when the market eventually turns around, which it always does.
Good perspective. Okay, so before investing in a specific area, you have to analyze the neighborhood itself. Is it improving or declining? What do you look for?
You look for tangible evidence of pride of ownership. Are houses generally well maintained? Do you see new roofs going up, people landscaping, fresh paint? These are subtle signs of neighbor investment and suggest the area is stable or maybe even improving, attracting people with upward mobility.
Got it. And you also have to dig into the less glamorous stuff, like the county tax assessor's website.
Oh yeah, it might be dry, but it's full of essential foundational info. You absolutely need to track the property's tax history. What are the assessed values? How often do they reassess? Are the assessments fair compared to similar properties? Are property taxes suddenly spiking in that area? That data is critical for accurately calculating your long-term holding costs and just validating all your other market research. Don't skip it.
Okay, you found the deal, done the due diligence, acquired the property. Now, the landlording part. This has to transition from being just a sideline into a real business, right? Systems are key again.
Absolutely. And it starts immediately with tenant management. Rigorous screening is your first line of defense against problem tenants. This means setting minimum, non-negotiable qualifications, credit score minimums, income-to-rent ratio requirements, and actually checking past landlord references. Don't just take their word for it.
And when you're interviewing prospective tenants, ask probing questions.
Yes. You need to assess their reliability. One key question the sources recommend is, for what reasons could you not pay rent on time? Think about that. The only truly acceptable answer is basically nothing. If they immediately start listing potential excuses, well, if my car breaks down, or if I have an unexpected medical bill, that's a huge red flag. It suggests rent isn't their top financial priority.
You want tenants who treat paying rent like paying the mortgage. It happens no matter what, even if things get tight.
Exactly. And if rent is late, you have to enforce the power of late fees. Late fees aren't really there to generate extra income. They are a behavioral training tool. They train the tenant to prioritize paying rent on time.
Even if you want to be the nice guy and waive it the first time.
Especially then. As hard as it might be, waiving late fees completely undermines their purpose. It sends a dangerous signal that your deadlines are flexible, that consequences aren't real. This is a business decision, plain and simple. Stick to your lease terms.
Makes sense. Okay, let's wrap this section with a look at negotiation tactics when you're acquiring the property. It's not just about the price tag, right?
Not at all. Terms are often just as, if not more, important. First tactic. Always anchor high when you're setting initial expectations in a negotiation. Research clearly shows that if you offer a range, the other party almost always gravitates towards the end of the range that favors them. By setting a high anchor point initially, whether it's your offer price or your expectation of value, you shift the entire perceived negotiation range.
Okay, anchor high. What if the money talk stalls?
Then you pivot to non-monetary terms. Look for things that might matter a lot more to the seller than they do to you, or vice versa. This could be anything. Offering a very fast closing, or maybe a flexible, slower closing if they need time to move. Maybe you waive an inspection contingency, risky but possible, in exchange for a lower price. Or you agree to take the property with some unwanted furniture they don't want to deal with moving.
That creativity can bridge a price gap without actually changing your bottom line number.
Exactly. And one final negotiation tip. Never rely on just one set of ears, especially during crucial conversations. Always review everything that was said. If possible, have a partner or backup listener there with you. You will inevitably miss small details, subtle shifts in tone, maybe nonverbal cues. Having backup helps ensure you catch those nuances that could make or break the deal. #tag.
All right, we have covered a lot of ground. We've completed this deep dive into the 4 essential pillars for figuring out if real estate investing is right for you. We talked about cultivating the disciplined mindset, mastering the financing tools, selecting the right strategy active versus passive, and diligently building those necessary operational systems and your team.
Yeah, this whole discussion, you can really think of it as a comprehensive self-assessment checklist.
Yeah.
Do you have the systems, the financial discipline to handle the risk that comes with leverage? Are you truly willing to dedicate the time required? Maybe meet those material participation hours for taxes, build that millionaire mastermind team. The mechanisms for building wealth are clearer now, hopefully, from the tax advantages like cost segregation to the power of finding a niche and acquiring deals creatively.
The strategies, the data, it's all laid out for you.
Yeah.
You have a detailed roadmap now of what it really takes to move past the hype and into the reality of long-term wealth creation through property.
But if we leave you with just one final provocative thought, something that ties right back to that very first section on mindset, it's this. The single biggest mistake investors make, especially new investors, it's simply not doing anything.
That's powerful. You now have the tools, you have the knowledge from this deep dive, but that last hurdle, it's often analysis paralysis. You could spend your entire life analyzing spreadsheets, crunching numbers, waiting for interest rates to be perfect or for that mythical perfect deal to just fall into your lap. And if you do that, you'll never actually start.
That transformation in your financial life, it begins the moment you stop waiting for everything to be just right. You have to start applying these systems, taking action right where you stand right now.
You are capable of generating massive, durable wealth. You really are. You have everything you need to begin that process today.
Don't settle for less than what you know you're capable of achieving. Time to take ownership.
Time to take ownership of your journey. Thanks for diving deep with us today.